I bonds or TIPS ETF. I've invested in both as an inflation hedge, and in this video, I'm going to share with you which one I prefer investing in myself right now, and I'll talk through my reasons behind that choice. Because everyone has their own unique situations and because economic times change, I'll go over the pros and cons of both TIPS and I bonds to help you best decide which option may be the best investment choice for you, whether that's now or in the future. And finally, I'll also tell you what I'll be looking at and planning to do once inflation gets under control. If you're looking for a video on I bonds and TIPS compared, this video is for you. But real quick, I want to first welcome you to Healthy, Wealthy, and Wise. We're talking about our financial wellness, and how to achieve it is my top priority. My name is Kevin, and on this channel, I share my experiences and the strategies I've used in my over 25 years of DIY investing. I want to welcome back everyone in the community that keeps me motivated to make these videos. And for anyone new here, if learning about easy, everyday things you can do to improve your financial health is something you're interested in, well, consider this your formal invitation to join the community. And all you have to do is press that subscribe button and turn that notification bell on. It's totally free, and it'll make sure you don't miss any videos as soon as they come out. Okay, on to inflation. This word has been on the top of everyone's minds, whether it's in the everyday world or the investing world. In our everyday lives, we're seeing everything costing a lot more. Gas prices, groceries, everything at the highest rates in 40 years. And for investors, that inflation has led the Federal Reserve to start trying to tamp it down by raising interest rates. And when interest rates go up, stock prices tend to go down. And if you're an investor in the stock market, you've seen quite a hit to your portfolios. And I'm right there with you. So knowing all of this, you've been doing your research and trying to figure out how best to invest in a period of high inflation, which is probably how you found this video. And most likely in your research, you keep coming across two popular options: Series I savings bonds, or just I bonds, and then also Treasury inflation protected securities, more commonly referred to as TIPS. Now in the past, I've made and released comprehensive videos on both types of investments, which were meant to give you a good understanding of what each of them are and how they work. And if you're still learning about TIPS and I bonds and haven't seen those videos yet, I'll link them in the description for you. I would really recommend watching them if you're seriously considering investing in either TIPS or I bonds. Now this video is different because today I'm going to compare and share my own personal experiences with I bonds and TIPS by explaining the pros and cons of each, the reasons I invested in them at the time I invested in them, and then finally tell you which one I prefer investing in today and why. So early last year, it was obvious to me that inflation was right around the corner after everything was returning back to normal, yet the Fed was still not raising interest rates. As someone that had never had to invest within a high inflation environment but was anticipating that time coming, I started to look at my options and found I bonds and TIPS, probably just like you. Now, I had never been a bond investor at the time, so I began learning all I could on both I bonds and TIPS, and ultimately I made my decision to invest in TIPS. The reason I invested in TIPS first was not because of the fundamental differences of how TIPS and I bonds works, where TIPS keeps a fixed interest rate with a principal that is adjusted with the rate of inflation, whereas with I bonds, the actual rate itself is what is adjusted. Again, if you don't understand this fundamental difference, definitely check out the videos linked in the description, as they will make this more clear for you. Anyway, as I was saying, that difference in how they adjust to inflation was not the reason I chose TIPS. I chose TIPS because of three other reasons. The first being the biggest reason for me, which was convenience. Unlike I bonds, where you have to invest in them directly with the US Treasury, you can invest in TIPS bonds through a TIPS ETF using any of your current investment brokers or trading platforms. Now you can also buy your own TIPS bonds directly through the US Treasury as well, but the convenience of buying a fund of TIPS with my current investment account, where I could easily buy and sell shares, just like I do with any of my stock ETFs I've invested in, was very attractive to me, and the main reason I initially chose a TIPS ETF over I bonds or even standalone TIPS. The second reason that I went with a TIPS ETF was for liquidity, meaning you could literally buy shares one day and then sell them the next day with no penalty. Even if you bought your own TIPS bonds directly through the Treasury, you could also sell it before maturity on the secondary market without penalty, but it's just not as easy as with an ETF. Now with I bonds, it's a whole different story. First of all, There is no secondary market for I bonds, meaning you have to buy and sell them directly through the US Treasury. And once you buy them, you can't cash them in for at least 12 months. There's just no way around it. So if you were to need that money anytime within the next year, you'd be out of luck because you won't be able to access it until a full year has passed. Because of this liquidity issue, an I bond is not where you would want to put your emergency funds or money you may need within the next 12 months. Now, after a year passes, you can sell it anytime afterwards, but another consideration is if you cash it in before holding it for less than 5 years, there is a penalty where you would have to forfeit the last 3 months of interest. Now, after 5 years, that penalty goes away, but you can see how that's quite a long time where inflation could have subsided well before you would be able to sell the I bond penalty free. And then finally, the last reason I went with a TIPS ETF over an I bond was the annual limits. With an I bond, you're limited to buying up to $10,000 worth of I bonds for yourself. That limit does not apply to TIPS ETFs. Now, if you're married, your spouse could buy their own I bond and you could buy I bonds for others as gifts, but for yourself, per person, per year, you're limited to $10,000. Now, that's not an insignificant amount of money, but if you're someone that has a fairly substantial amount of savings, this just means that I bonds won't be able to fully hedge your invested capital against inflation. So let's say you have an investment portfolio of $500,000. You can only utilize I bonds to hedge 2% of your portfolio against inflation. Now, that doesn't mean you can't or shouldn't consider I bonds. It's just that if you have a higher net worth, they would only serve as a small part of your inflation hedging strategy. Alright, so at this point, you're seeing the pros of a TIPS ETF over the cons of I bonds, and probably are understanding why I first went with a TIPS ETF. But as I shared, I have bought an I bond as well. So let me now explain how I came to investing in an I bond, which is where you'll see the big potential advantage of an I bond over a TIPS ETF. So as I mentioned, I bought into a TIPS ETF early last year, and I've held it close to a year and a half now, where I've had 5 quarterly dividend payouts to me. The dividends over this period of time have provided me an annualized return of 5.3%, which isn't bad, right? Especially after seeing the big negative returns on the stock market year to date, and remembering that the inflation rate when I first bought into the TIPS ETF wasn't as white hot as it's been the last few months. But here's the problem with the TIPS ETF and buying it now. Being that it's on the secondary market, you're buying shares of a fund that are constantly at the whim of traders who are pricing in not only the underlying values of the TIPS the fund holds, but also how they see inflation trending in the future. So while we've seen high levels of inflation this spring into the summer, we also know that the Fed is actively and aggressively hiking rates, and we expect that to begin to lower the rate of inflation in the near term. Because of this, the value of each TIPS ETF share has since gone below the price I bought it at because traders are always speculating or looking into the future. When I do the math over the period of me owning the TIPS ETF with the dividends earned minus the non-realized capital loss, I'm currently ahead by only about 1.5%. That's not great, but again, better than the stock market has been doing recently with declines around 20%, and still better than any basic savings or money market accounts. Now in a minute, I'm going to tell you what I think will happen with my TIPS ETF in the near term. But first, let's get back to I bonds and what I consider to be the big advantage of buying them, at least right now. And that is, depending on when you buy an I bond, you can know, not speculate, but 100% know your actual guaranteed rate of return for at least the next 6 months. And if you buy it in one of 2 specific months of any year, you can know your rate for the next 12 months, which would completely cover the mandatory time you have to own the bond before you're eligible to redeem it. I'll tell you that trick in a second because that's what I did for myself. For just a very quick background, the adjustable inflation rate component of an I bond is updated every 6 months based on changes in the CPI or Consumer Price Index. This update to the inflation rate occurs 2 times per year, on the first business day of May and on the first business day of November. Again, my I bond explain video can give you more details on how this works, but for the purpose of this video, what you need to know is that any I bond bought today through the end of October 2022 will pay interest at 9.62% for 6 months from the month you bought it. As I said, you have to hold it at least 12 months. So let's take the completely hypothetical worst case scenario where all of the Fed's tightening works quickly and the inflation rate drops to 0%, or even if it goes negative where deflation occurs. Even if that were to happen, you still would have at minimum a 4.81% return for the next 12 months, which would still be better than any interest-bearing bank savings account and better than what my TIPS ETF has done since I've owned it. Although just always keep in mind that comparing past performance to future performance is not an apples-to-apples comparison. To that point, I-bonds weren't paying anywhere near this rate last year when I first bought into the TIPS ETF. Now for the trick. Okay, maybe trick isn't the right word, but a strategy to know what your I-bonds interest rate will be for 12 months instead of just 6 months. So in April and October, the months before the updated CPI adjustments take effect, the updated CPI numbers are released by the Labor Department that will let you know what the upcoming rate adjustments will be, and you don't have to figure it out. Those numbers will be reported by any reputable news source. So what this means is, if you buy the I-bond in April or October, you will get the current rate for 6 months, and then the new rate will take effect for the next 6 months after that, allowing you to know your rate for an entire year. This can be a little confusing to understand, so if you're unsure, you can check out my I-bonds video or go to treasurydirect.gov for more details. So anyway, here's what I did. In April, I saw the rate was jumping to 9.62% starting in May, and that definitely caught my attention. As of April, the current rate was 7.12%. So I bought the I-bond in April knowing that I would get 7.12% for the next 6 months, which would then go up to the updated 9.62% for the following 6 months. That left me knowing that I would be guaranteed a return of 8.54% for the entire 12 months I'm required to own the bond before I could sell it. And that's guaranteed, something a TIPS ETF can't provide. So what does all this mean now and for the future? First of all, for right now, with the current rates being what they are, I strongly prefer investing in an I-bond over the TIPS ETF. All of the positives that I shared for the TIPS ETF over the I-bonds don't overcome the relatively high guaranteed rate of return of the I-bonds at the currently set I-bond rates. Looking ahead, here's some thoughts to consider. First of all, I don't claim to be able to see the future, so take this for what it's worth, but what I see happening is the Federal Reserve's moves will begin to reduce the rate of inflation. There's evidence it's already starting to happen. Therefore, the next CPI adjustment to the I-bond rate is very likely to be lower. We'll see what it actually is in October. Whether you buy an I-bond now or in October, you will still be guaranteed 6 months of 9.62% before the new rate kicks in. The benefit of waiting until October is you'll know what the following 6-month rate will look like, allowing you to know your 12-month return. Of course, by waiting, that means your 12-month requirement of holding the I-bonds is delayed until after you buy it. The fact you can't sell your money for that period of time is the big downside for I-bonds. And as I mentioned earlier, one of the reasons I opted against buying them at first. Initially, one of my concerns was the penalty of redeeming the I-bond before 5 years. However, I've since come to the conclusion that once the I-bond's earning rates start to drop as inflation drops, I'll consider selling the I-bond after 3 months once a lower rate takes effect, which would minimize the penalty for redeeming the I-bond for holding it under 5 years. And I don't expect to hold the bond that long because I do think inflation will be tamed to the point where I'll then want to take that money invested elsewhere. But if I'm wrong and inflation rates remain high, I'll just keep holding the I-bond and considering buying more up to the annual limits each year until inflation subsides. As for the TIPS ETF, in the short term, I'd probably predict that the dividends in my TIPS ETF will continue to increase because the underlying TIPS bonds that the fund owns will continue to be adjusted up due to the current high levels of inflation, but the value of the ETF shares will most likely continue to decline as traders speculate future declines in the rate of inflation due to the Fed's tightening. Ultimately, the issue with the TIPS ETF is that you have to consider the speculative nature of the holding and realize that it adds additional risk. Looking back, I thought I was ahead of the game by investing in the TIPS ETF when I did, but really I needed to invest a little earlier than I did. Lesson learned. So when I consider all of these factors for myself, the I-bond is where I would invest today. But timing is important when you consider buying either an I-bond or a TIPS ETF. Down the road, as economic times change in the future, I'll look to buy TIPS ETF shares when I think inflation will be coming, not when it's already here. And on the flip side, I'll only buy I-bonds once the inflation is already happening and the higher rate is set. So that's what I've done and my thoughts on these two popular inflation hedges. How about you? What do you think? Today, are you buying into a TIPS ETF or are you buying I-bonds? Let us know in the comments. I hope you enjoyed the video, and if you did, please press that like button and share with your friends and on any of your social media sites and forums you're on to help spread the information. And again, if you're new to the channel or just an occasional visitor, we'd love to have you join the community. You just gotta push that subscribe button. We'd love to have you on board. Until next time, thank you for watching and have a great day.